This conference.
Okay, Lonnie, if you want to call the meeting to order.
Okay, I was waiting for her to complete her sentence. This conference.
Yeah, she
Um,
thought.
Good morning, everybody. Good morning. I'm going to call this meeting to order. Let's see, at 9:02 a.m. on April 21st, 2023. And as you can see, we've got a jam-packed agenda. Let's see, first, public comments.
Next slide, Joe.
Okay, so we're hearing none. Let's go on to our next agenda item.
Great. Joe, if you can just go one more slide. Just a quick overview of the consent agenda. We've got 8 resolutions here. Excuse me, that should say through number 8. So the first one is our meeting minutes from the last meeting in March. We've got our under 500,000 and no more than $1 million staff approvals memo. There are 3 CPACE transactions in there, just under $1 million. And then we've got 5 CPACE transactions. You'll notice today on the agenda, we have a really extensive transaction review. So we thought we would do is to put this on consent. These are all standardized projects, less than $600,000 that we see there. So resolutions 3 through 7 be the recommendation for approval of those transactions. Let's go one more slide, Joe. And then resolution number 8 is the extension of an existing CPACE approved project. So that would be resolutions 1 through 8 on the consent agenda. And then we provided in the materials our progress to targets for through Q3 of FY23 and our under 100,000 and no more than 500,000 report out on any staff approved restructured transactions. And we don't have any, we're just reporting out. So the recommendation would be to approve resolutions 1 through 8 on the consent agenda.
Do I hear a motion to approve?
So moved, John Harity.
Thank you, John. Do I hear a second?
Brenda, I second.
Thank you. All in favor?
Aye.
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 Opposed? Thank you. Opposed? Any abstentions? Okay.
Alani,
Yes.
it's John. Just a quick comment. It's great to see all that CPACE activity. That's
It
great.
really is. It really is. I remember when we were debating, well, we've debated it many times because there's also the residential one that keeps coming back trying to get through. But the reality was, to get legislators to understand what the heck we were talking about and then to, finally get it through and then to see, oh my gosh, it's actually out there getting stuff done. So it's pretty exciting.
Well, we're going to get more of an in-depth coverage on that, John and Lonnie, right now when Mackie and the team work through a number of other transactions.
Okay, so let's hear our next agenda item. So it's Mackie and the team.
Dean, perfect.
Yes, thank you, Chair Reed. So yeah, I agree. It's great to see all of these transactions. I mean, typically they're kind of trickling through, but obviously not today, which I'll talk about in a little bit, sort of what's going on with that. But first, given the number of transactions, I'll do a pretty quick run through of just where we are on progress to targets. You could go to the next slide. So at the top level, which is the top of the slide here, when you aggregate everything together, in terms of our projects for through Q3, we're at 75% of the goal, 74.3 to be exact. So 3/4 of the way through the year, that's pretty much exactly where you want to be. On the capital deployed target, as you can see, we're a little less than 3/4, we're at 60%. And then on our solar deployments, we're at just under 1/4 of the target. So why the disparities between, you'd think if you're, where you want to be on the project count, the other ones would be there as well. Well, when you break it down into the program, sort of the what's going on becomes a little more clear. So our project goal is really driven by SBEA, where that's the partnership with EverSource, where you've got numbers of smaller transactions with small businesses and municipalities. The goal for the year is 839 projects. We're, as you can see, just over 3/4 of the way there. So when you look at the project goals for the rest of the programs, they're very small when compared to that SBA goal. So as long as we're doing well on the SBA goal, our projects or goal is going to be doing well. The other programs, however, account for much larger transactions. So because the numbers on the project side are a little behind there, that's why you see the capital deployed as well as the solar target being under. However, aside from multifamily term, which I'll talk about in a minute, I think we're in a good place with the rest of the goals. For the commercial lease, which is that's our we really need to change the name because it's really our commercial PPA. We've got our that's driven by the largest chunk of that is our state work, and our second portfolio of projects is making its way through. It's doing the delicate dance of contracting with the state right now, working with 3 state agencies, as well as OPM, DAS, and the Attorney General's office to just get the contract signed. The projects are ready to go. Everyone's signed off. It's just working, doing that paperwork. So those are in a good place. That's just under 10 megawatts, about 10 projects. So that'll make a huge role in making up for where we are with the capital deployed and solar target. Feel good about getting that signed before the end of the fiscal year. We're still working out data issues with IPC. So our municipal solar map projects that we've signed this year are not reflected in that goal. So I think by the end of the year, when we're having this conversation, we'll be in a good place on the commercial lease. CPACE, today we got just almost 14 million in transactions that we're bringing forward. This is really driven by why this aggregation of projects, as I mentioned, has been a trickle. Now all of a sudden we've got all these projects when you look at today, plus the 5 projects for I think 4.5 million that we're going to bring for deployment in May, and then several million of transactions at the staff level approval. So we've got this huge chunk of projects. What's driving that is the new NRES program that has created, because of the timing of that, the last auction was last year towards the beginning of the year. Nothing happened until the auction at the beginning of this year. So you've had solar developers and us out there selling projects and customers buying in, and then them just waiting to get their awards. So that should be happening at the beginning of May. So as I'll talk about in a minute, we've ran a process to sort of get all these transactions ready to go. So long way of saying on the CPACE side, once we work our way through these approvals today and the utilities give out their solar NRES awards, I think we'll be in a good place. But still a lot of work to do to actually close those transactions, but we should be able to get a good chunk of them through before the end of the fiscal. And then switching down to the vulnerable communities progress. Overall, as you can see, this is our Justice 40 goal. We're at 66% in vulnerable communities of our total investment, excluding SBEA, because we're still working through the it's 2 things. Try to work through the data with the utilities to make sure we can locate where those are. And also, we don't really have a lot of control over where the investment goes because the utilities run the program. Matt, thank you. Matt Brunelli just sent me a private message. I mentioned where the one area where we won't be okay, which is the multifamily term. We had a goal of 6. We closed one project there. I actually think we'll cheat our way into doing well here because we have a CPACE transaction that y'all previously approved, the Reading Life Care, that is technically multifamily because it's a senior living facility. That's a $3 million transaction. So that'll get us, that'll be counted towards this. We'll meet our goal, but kind of arguing against myself here, but I would argue that's really not the spirit of the goal, where we're really targeting the affordable multifamily sector here. And when we set that goal of 6 projects, we've been working with our housing agency partners and Pura to get the framework for affordable multifamily solar and storage set up. That is up and live, and we're active in the market. We've got about a dozen different transactions that we're working on, but it's new policy, new program. We're still working our way through the kinks, so I think that's just going to take longer than we thought. So let me pause there for any questions or comments. Okay, well, let's move then to our first transaction in honor of Chair Reed in Branford, which Catherine Duncan will present. But let me just real quick, I mentioned sort of what's led to this clumping of transactions. A lot of it was, as I mentioned, the NRES timing. But I just want to, the team came up with the idea of, in order to try to build this pipeline prior to the stuff actually happened in the market with the NRES awards. Back at the end of last year, we went out with an offer that if you got your application in for CPACE financing and all your financial information, we would lock your rate in until you got your award, and also underwrite your project, because now you have to make a pretty big deposit when you put a bid in for an NRES tariff. So we wanted to help customers that were counting on CPACE financing have some certainty that when they put that deposit down, that they would have financing if they ended up getting the award. We didn't want them thinking that they put down thousands of dollars and then for some reason they'd fail underwriting. So financing programs team and the finance team did a ton of work over the last few months to get this out to the market, put together a process to track all these projects coming in, collect all the information, and then do all the underwriting. So we're in a little different spot than we typically are with transactions that we bring to you, because typically they're completely ready to go, right? They've got their ZREC in the past. Last year they would have gotten their NRES award. Here, we don't yet have the NRES award. The utilities say those will come out at the beginning of May. But we'd like to go ahead and get your approval so that as soon as they get them, we can, these customers, some of them have been waiting for almost a year. They're ready to go. So we want to be able to close right away and not have us be the holdup. So we've done all the diligence on the financial side that we typically do before bringing you a project. We obviously, whether they get the award or not is pretty binary. If they don't get it, we're not going to move forward. So your approval will be contingent on getting the NRES award. They also have not fully gone through the technical review yet, just because some of these inevitably won't get their award. So we don't want to spend money on the technical review if they're not going to move forward. So we've done we've got a lot of experience figuring out SIR on solar projects. Is pretty straightforward. So we've done the calculations. Once they get their award, we'll have our technical reviewer just do what they typically do, double check everything. Obviously, if that fails, they're not going to move forward. So the approval will be contingent on that sort of technical review confirming the numbers that we're putting forward for you here today. So with all that said, unless there's any questions on the process, I'll turn it over to Catherine Duncan to present on the first of these CPACE transactions. Okay, Catherine. Catherine, are you there? You're muted if you're talking. Looks like you just came off mute, Catherine.
I'm trying to. Can you hear me?
Yes, now we can hear you.
Now we can hear you. Yeah.
Sorry, I don't know what that delay was. All right, I'm trying to use my cell phone because it's better communication. So I'm afraid now to mute the screen. Anyway, I'm just going to leave both on. It doesn't sound like there's any consequence. All right, so Branford's the first transaction. If Joe, if you could move to the next slide. Okay, so this is at Elm Street in Branford. It's a company called Cherry Hill Glass. The project will have 2 solar arrays and 2 roofs. Cherry Hill is a structural glass manufacturer in Branford. The project received the maximum energy on the line grant of $40,000. And just for extra information, this owner is also doing a second smaller project around the corner at a building that he owns, and that'll be a staff approval later this month or the next. Okay, so it's a $1 million project. As I said, 2 roofs, 2 arrays, and you can see the savings here. So Joe, next slide, please. And David Beach, who is the underwriter, is going to speak to this slide.
Thanks, Catherine. Yeah, my name is David Beach. I'm a senior manager on the investments team. Going to pop in here for one slide to tell you a little bit about the underwriting for this project. You also see me and others on the team just popping in on each one of these CPACE transactions to talk a little bit about the underwriting, and we'll also be available for any questions for each of these projects if the board has any. So yeah, excited to talk a little bit about 20 Elm Street. As Catherine mentioned, it's a $1 million project, loan to value of 61% and a lien to value of 19%. A really strong debt service coverage ratio. We calculated debt service coverage in a couple ways. One, this property had a private appraisal in the last couple of years, and that private appraisal included an estimation of the net operating income that this property could generate if it had to be rented out. And we also looked at the operating company, which Catherine mentioned, which is Cherry Hill Glass. They have a strong record of profitability, though they did have a dip in profitability last year. So as a result, we spoke with management, dove a little bit deeper into the financial statements, and learned that the company had a significant number of projects in 2022 that ended up being delayed and weren't able to be completed as a result, largely of some supply chain issues that were outside the company's control. And we were able to review the company's pipeline of contracted revenue. So they have about $66 million of contracted projects that had yet to be built at the end of 2022. And so looking at that and their history of the company, we had a lot of confidence that they're going to continue to be profitable and another great company. That is it for me, but I'll be around at the end of this presentation for this project if there's any questions. And with that, I'll hand it back to Catherine.
Thanks, David. Next slide, please.
Hey, Catherine, David, I just had a quick question on this. On the cash flow graph for this, I just want to make sure I'm reading it right. Is the cash flow negative for the last 5 years for the consumer?
Yeah, I don't have it in front of me. I'm sorry, I don't have it in front of me. It is possible sometimes with the SIR to be over 1 because you have that strong first year of the ITC, and so it might be slightly negative in the last couple of years. Yeah, I'm sorry, I don't have that directly in front of me, but you're probably saying.
It's just a question of when we have that, if that is the case, and we know that sort of when we're doing the underwriting, do we make the host aware of it? And do we still, I know for a while, Bert maybe remember, we were offering to sculpt these payments a little differently. So for example, if they sold it in year 15, the new owner wouldn't be coming in with a negative cash flow. Do we make them aware of that and offer them any options if they want to take advantage of them?
Yeah, I mean, I know there's always an option to shorten term, and we have sculpted amortizations before. And I do believe they always have a chance to see the technical review that is done by D&D as well. I'm not sure if they run the CPACE team.
I just thinking ahead, I think we should, I don't know what everyone else thinks, but I think we should make an effort to really point those instances out, just because at some point people are going to say, wow, these solar deals are terrible. And when you have a new owner in year 15 and they're paying more than they would be paying under at least under the modeling. So just a thought that we should, make an effort, concerted effort to point that out to the customer.
I think it's a good call.
Yeah. I don't know, Catherine, if you want to say on this particular one, but yeah, that is something since you pointed out, some time ago, it's something we always look at. We now are, especially with nonprofits, allowing a penalty-free prepayment using the ITC grant to help out with the, sort of reduced principal, help out with cash flow in later years. And I mean, in this case, they're also getting new roofs. So I think that's what, in many cases, the borrowers love solar, but they also love 20-year money for a roof. So, I think we see maximization to an SIR of 1. And I mean, I don't think this was right at 1, but we do see that showing that they're not as concerned about the cash flow as much as access to the capital for really facility needs.
And of course, I have not discussed the amortization schedule with the owner, but I can do that, obviously, and offer to sculpt it. So I'll definitely make a point of having that conversation with him once the awards are out and we have, we confirm the project has met all contingencies.
This is Lonnie. I just want to say about this company, which has been around, I think, since the 90s. Among the things they manufacture are these curtain walls of glass. And I think one of the projects was the Connecticut Convention Center. So they've done, a lot of big projects, but beyond that, they keep expanding, their arsenal of what they offer. And I think there are opportunities there in the whole world of glass to have an impact in terms of, the kinds of things we're doing to save energy in that arena. So I think it's very good to have them in our little family.
And they do a lot of work in Connecticut. If you go to their website, they've got many Connecticut buildings that people will be familiar with, and you'll see, obviously they've taken the pictures of huge sheets of glass, and that's all their work. So if anyone wants to look them up, you'll see a lot of familiar places. So okay, thank you. So this slide, the 5 Ws. So what is $1 million construction loan for, as we've said, 2 solar arrays on 2 new roofs. The project will begin this year, and it's 20 Elm Street in Branford. And unless there's any questions about any of these, we can just move to the next slide. So the tear sheet here, this is, as Mackie pointed out, everything's been done a little bit differently. So this tear sheet is pre the technical review by DNV and pre the tariff. So this is an estimate. But again, as Mackie said, we and our contractors are very experienced now at putting together the SIR calculator. So that's what we use to substitute for the DNV part. So we feel confident that these numbers should pan out once everything has come through. And just to point out, this is a deal that also requires lender consent, and that still is pending at this point. Smart Roof Solar is the contractor. They've been in the program for a long time. They've also done PPAs with the Green Bank. And you can see that the SIR on this project is a 1.74. The next slide, please. And this reiterates, again, that based on the estimation in the SIR calculator, the project metrics, and I can see that the savings to investment ratio on this page is slightly different. So we'll have to look at that. And again, it's $1 million project with a 20-year repayment period. if there are any questions, if there are no questions, yeah, there we go. And then the resolution. And I have to confess, Mackie, do we vote on this now? Does this get done now or later?
Yep, we turn it back to Chair Reed.
I'm sorry. Yeah. Okay, then. It's Chair Reed. Back to you.
Thank you. So do we have any more questions about this, or do I hear a motion to approve Resolution 5?
So moved. Adrian speaking.
Thanks,
This is
Adrian.
Matt.
Do I hear a second?
Bettina, second.
Thank you, Bettina. All in favor?
Aye.
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 Opposed? Opposed? Anybody abstaining? Okay, so let's move on to the next item.
Okay, so this is me again. This is a transaction in Milford. Next slide, Joe. Thanks. So this is a project at 80 Wampus Lane, which is a office complex, and its tenants are predominantly small manufacturers. These are new owners, and they've recently replaced the entire roof, which they did not use CPACE to do. And now they're seeking to put a large solar PV project on that new roof. The project is 1.25 megawatts. It'll be a $2.3 million project with projected savings of 141 MMBTUs. And we can go to the next slide and throw it back to David.
Thanks, Catherine. Yep, so happy to talk about this underwrite a little bit as well. Loan to value is just under our threshold of 80%, with a lien to value of 27.5. For the debt service coverage ratio for this project, because it was already being rented out to commercial tenants, we looked at the financial statements of the operating and owning entity, which is Milford Holdings. And we also looked at a recent appraisal that was made for this property, which once again had a breakdown of an estimated net operating income based on comparable buildings in the area, market rent analysis, and other analysis by the appraisal company, and those closely aligned and have debt service coverage above 1.5 for the total 20-year term of the loan. I'll be on hand if there are any other questions, but we'll first pass it back to Catherine.
Thanks, David. Okay, next slide, please, Joe. Okay, it's a project for $2.3 million going to Milford Holdings, LLC. The project will commence this year. And yeah, it's at 80 Wampus Lane in Milford. So Joe, you could go to the next slide. Thank you. And again, this is the same story based on estimates. It's pending a mortgage approval by Union Savings Bank. This is a new contractor for the program, Evergreen Energy, which we have another Evergreen in the program, but this company hails from New Jersey, so it's a different Evergreen. The SIR is 1.6, and yeah, unless there are any other questions, this, yeah, thank you. Again, 1.6 for the SIR. It's a 20-year term at 5.75. And if there are no questions, we can move on to the next. We can send it back to Chairman Reed.
Yeah, before doing that, Catherine, you mentioned subject to mortgage approval, but just to be specific, it's mortgage consent approval. Just want to make sure that the directors don't believe that this is a refinancing or anything like that of the underlying mortgage. We're talking about a consent from the mortgage holder, which is Union Savings. Thanks.
Thank you, Bert, for clarifying. Thanks. So yeah, if there are no questions, we can send it back to Chairman Reed.
Thank you. Matt, no questions?
Not yet,
No?
not yet, Lonnie, thanks.
Okay, I just want to make sure that
I know, I'm
you
awfully
weren't on
quiet.
mute or something. Okay, so do I hear a motion to approve?
So moved, Matt.
Do I hear a second?
Second, John Harity.
Thank you, John. All in favor?
Aye.
Aye.
Aye. Aye. Opposed? Any abstentions? Okay. Moving on to the next item.
This one, Elise Buzelli will be presenting this one. I'll turn it over to
Great,
her.
thanks, Mackie. Good morning, everybody. So this first transaction I'm presenting is in Southington. It's at 44 Robert Porter Road. This is for CV Tool. They're a manufacturing company. They were established in 1980, and they specialize in creating machine parts and tooling for the aerospace and aircraft industries. So this is a $1.68 million project. It consists of 2 rooftop solar PV systems totaling in 516 kilowatts, also roof replacements in this one as well. Next slide, Joe. And I'm going to pass it over to Mariana Treef to talk through the underwriting for this one. Mariana.
Good morning, everybody. Mariana Treef here from the investments team. So again, an almost $1.7 million loan for 2 arrays totaling about 515 kilowatts. The transaction has a loan to value of 60% and lien to value equivalent to 56%. We looked at the debt service coverage ratio of the operating company, which shares ownership with the property owner. And based on their last 3 years of net operating income and then taking an average of those two, they have a debt service coverage ratio of over 12. So quite healthy entity.
Great, thank you, Mariana. And so this is just showing you the project cost again here, and the property owner here of Karsu Realty. This project should happen in 2023, and again located at 44 Robert Porter Road. And then on this slide, just wanted to point out that they're awaiting 2 small netting NRES tariffs. Mackie mentioned the whole issue with the netting or with all of the NRES tariffs, and how we're waiting for so many, which is why we're bringing all these projects to you in this way today. So they're waiting for 2 small NRES tariffs, and there's also no mortgage on this property. This project is going to be done with Green Earth Roofing Solutions as the contractor. And then, as Mackie and Catherine already mentioned, this project is in the same boat. It has not completed a full technical review yet. So the numbers that you're seeing here are based on information provided to staff by the contracting company. And of course, the approval for this project would be contingent on the property owner receiving the NRES incentive. So we can move to the resolution, and back to you, Chair Reed.
Thank you. Are there any questions? Okay. Do I hear a motion to approve this resolution?
This is Bettina, so moved.
Thank you, Bettina. Do I hear a second?
Matt, second.
Thank you, Matt. All in favor?
Aye.
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 Opposed? Uh-oh.
It's my cat, sorry.
The
She's for
cat's
this. She's
opposed to
for
this
this. She's not opposed. She's not opposed.
Okay, good. Okay, and any abstentions? All right, moving on. Next item.
Okay, this one's me too, with special special guest, my cat Jezebel. So this is a project in in South Windsor at 420 Ellington Road. This is a self-storage facility owned by Admiral Holdings. It's a $3.2 million project for a rooftop solar PV system totaling 1.45 megawatts. We can turn it to the next slide. And I believe David was the financial underwriter on this one, so he can give us some background on this. David, over to you.
Thanks, Elise. Yeah, once again, we have loan to value, lien to value within our underwriting guidelines at 62.4% and 34.2%. This is, as Elise mentioned, a self-storage property. Admiral Holdings also owns another building in another property in South Windsor, just down the road, which will actually be the next project that we'll be presenting to the board here in just a few minutes. These two properties, the appraisal we received covers both of them, and the mortgage is actually over both of these projects as well. So we looked at the square footage of each property, and roughly the amount of units, self-storage units at each of the properties to allocate effectively how much the mortgage is for which property, and the same thing for the appraisal. We also did the same thing because this company owns both these projects. When looking at the company's EBITDA for last year and allocating it to each of these individual properties. So when looking at the EBITDA for the company last year and in allocating it to this property, we saw a strong debt service coverage ratio above 1.5, which is also mirrored by, once again, the net operating income that was estimated in the appraisal based on market rate analysis in the case that there happened to be a default and this property needed to be rented out. With that, I'll hand it back to Elise, but I'll be on hand if there are any questions. Thanks.
Great, thanks, David. So this project, $3.2 million project, again owned by Admiral Holdings and located at 420 Ellington, hoping to commence in this calendar year. And then just quickly here, just showing again the 1.45 megawatts of solar. This is a buy-all, sell-all, a large buy-all, sell-all NRES project. So they're hoping for that award. So looking to self-storage facility using the buy-all, sell-all to maximize the roof space that they have available there. And again, this one in the February auction, so awaiting that award. David already talked through the mortgage, and this project is being completed by PurePoint Energy.
Yeah, I'll just point out, Elise mentioned the sort of maximizing the roof. It's great, for over a decade now, solar system sizing has been tied to on-site demand. So you never would have seen a self-storage facility like this with a 1.5 megawatt solar project on top. But last year when the General Assembly started recognizing that you had a lot of good roof space not being utilized for clean energy, passed a policy to allow regardless of building demand, you could maximize the roof. So that, we're seeing here the fruits of that policy change last year with what, again, I think it's a great project. Otherwise, you'd have a very small solar project on this huge roof to serve, storage facilities tend to not have huge demand. So it opened up this great market.
Okay, and then same situation here with the technical numbers. Numbers were provided by the contractor to staff, and again, this has not gone through full technical review and will be contingent upon receiving the NRES award. So with that, I will pass it back to Chair Reed.
Thank you. Any questions on this particular project? All right. Do I hear a motion to approve Resolution 12?
So moved, Matt.
On Harity.
Okay, so Harity,
I'll
and
second.
then Matt is second. Okay, All in favor?
Aye.
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 Opposed? Abstentions? Okay. Moving on to our next item.
All right, me again. So this is the 688 Sullivan project. This is the other project with Admiral Holdings that David just mentioned. So also in South Windsor, just right up the street from 420 Ellington. This is a smaller project, $710,000 project for almost 300 kilowatts of rooftop solar PV. And I will pass it back to David. I think you mentioned most of this, but back to
Yeah,
you.
just like the last project, we looked at the profitability for this company as a whole and allocated the correct amount to this property. We also looked at the appraisal and the estimated net operating income of the property in case it needed to be eventually rented out. So that's how we got the debt service coverage of 1.64 on your screen there. Back
Thanks,
to you,
David.
Catherine. Elise, sorry.
No problem. So again, $710,000 project with Admiral Holdings at 688 Sullivan Avenue, and project is looking to begin in this year. Okay, so again, the project, almost 300 kilowatt solar system, rooftop solar system. And this project is also looking for a buy-all NRES tariff. So again, maximizing that roof space for this self-storage facility, as Mackie just explained.
Elise, I have a question on this and the last one. Just, I know we talked about it previously. It's not these projects specifically, but they both apply. Have the property tax issues been worked out with the buy-all tariff? You know, they don't appear to qualify for the property tax exemption in 1281. So A, has that been worked out? And B, if it hasn't, are we at risk if the local municipality decides that the fixtures, the personal property aren't tax exempt? Has that been accounted for or looked at?
It's something where so no, it's not resolved. Unfortunately, we are actively working with the E&T committee on some language that hopefully will get into a bill this year, and hopefully they'll take our feedback to try to close this, the group of projects, the buy all generally, you could interpret as being outside of it, and then, or you could, depending on the town assessor and how they view it, or just buy all that are oversized. So we're watching that closely. If we can't get that clarity, then yeah, it's something we'll have to take into account for this project.
So
Still up in
who's
the
at
air.
risk?
Yeah.
Who's at risk on the financing side, Mackie? If there's a big tax bill, who pays it?
The property owner.
Under the agreement, it's the property owner.
Yeah, 'cause they're owning the system, so
Okay.
it would go to them. So yeah, something we're for all these projects, we're watching. Like I said, we're actively working on it. If we can't get it resolved, then it's something we'll have to go back on for these projects.
And I assume they're aware of that as well.
Yeah, well, yeah, for the ones that aren't, we're certainly make sure we're monitoring. We wouldn't, close until we have resolution.
Okay, thanks.
Okay, and then again, same situation here. Metrics were provided by the contractor to staff, and still awaits a full technical review, and contingent upon receiving an NRES award. With that, back to you, Chair Reed.
Thank you. Any more questions related to this particular one? Okay. Hearing none, do I hear a motion to approve Resolution 13?
So moved, Matt.
Thanks, Matt. Do I hear a second?
Second, Adrian.
Thanks, Adrian. All in favor?
Aye.
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 Opposed? Thank you. Opposed? And anybody abstaining? All right. Moving on to our next item.
And we'll go back to Catherine as we move to Stonington.
Can you hear me, Mackie?
Yes, we can hear you.
Yes, we can hear you.
Okay, thank goodness. Okay, thank you. All right, so 62 Maritime Drive in Mystic. This is Enco Chemical, and you all saw this project back in December when we initially came with the full 3 phases to this project, and it was approved. Now, we're coming back for 2 reasons. One, it would have needed to be extended, the approvals, because so far only the lighting, which was a $1.2 million project, has closed and is underway. And we're at the point now where the HVAC components and some of the control components are ready to go, but that approval expired. But in addition, they're ready to add their solar project into this. So we're coming back with, again, the full package for approval. So that's where you're seeing it again. And to refresh your memories, this business is a pre-revenue biotechnology company that has sophisticated investors, including Bill and Melinda Gates Foundation. Connecticut Innovations is also an investor. And again, it's $3.7 million, and that includes all components: the lighting, installation, controls, HVAC, and the PV system. Next slide,
Catherine,
please.
just to clarify, I think the last approval did not include the solar, correct?
Correct. Yes.
Correct. So we're
The other
adding that. So we're
components-
sort of taking the previous package, which was phase 1 and 2, and adding, sort of re-upping our authority for that, and then adding phase 3 of the solar.
Yeah, thank you, Mackie. Okay, and I actually think David's going to wait till the last slide to comment. So, I'll just point out it's a 5.6% loan at 17 years for $3.7 million, and the ratios are within our guidelines, and the DSCR is 1.6. Next slide, please. And again, okay, we've got $3.7 million. The project has commenced and will continue throughout this year and quite possibly into the next year. This is for Enco Realty, which is the real estate holding company, for Enco Chemical, the operating company at Maritime Drive in Stonington. And this tear sheet has again, a lot of estimates. Obviously, there are some actuals in here, to combine for the overall summary of the project, but all the other, caveats apply. We'll have, once they get their netting, they're apply for a netting award, and when that's approved and we get the revised lender consents, we will move ahead. Earthlight Technologies is in here as the solar contractor, but they're also working with Siemens, and there's a subcontractor for some of the HVAC. And next slide, please. And again, it's a 1.32 savings to investment ratio, and all these numbers will be updated when everything's finally pinned down and the awards are out. Next slide, please. And this is where David's going to take over.
Thanks, Catherine. The board saw this back in December, but I want to just give everyone a bit of a refresher. So how we got comfortable with this underwriting is a couple different things. Enco has a really strong business plan. They use DNA encoded libraries, artificial intelligence, machine learning, and structure-based design to develop biotechnology projects. They're at a really strong cash position. They've closed an equity raise in summer and fall of 2022. And at the end of 2022, they had $83 million of cash on hand and a strong one-way to be able to maintain that cash for the next couple of years. I'll explain further in the memo if anyone has questions. And the other key items here are strong investors. You see, Catherine mentioned before, Bill and Melinda Gates, the Intera Capital, and our own Connecticut Innovations. They have really strong strategic partnerships with key industry companies like Dow and DuPont and Monsanto. And they also have a really strong management team that also has a ton of experience in other agricultural industry companies like Syngenta, New Farm, and Bayer. So with the kind of combination of these factors, the Green Bank was able to get comfortable with this underwrite. And we also looked at the ability of the property to attract tenants and the potential net operating income of the property in case we had a default on the seat-based assessment and rent out the space. And so that's also how we calculated debt service coverage ratio. Happy to answer any questions if there are any.
So is our agreement with the company or the owner of the property?
Yeah, so I believe it's shared ownership. I think there is a separate Enco Realty company that is just a holding company, but shared ownership. I think one's just a subsidiary.
So the 80 some odd million dollar balance sheet is something we can rely on.
Yes, it is. They're the ones who are going to be paying.
Okay. Are there any other questions for David? If not, then the next slide, please, Joe. The resolution is missing. There should be a resolution here.
It should be resolution 14 in the resolutions document.
Yeah, 14.
Can we, without the slide, can we move ahead with Chair Reed?
Yes.
Yeah. Thank you.
Okay, are there any more questions? Do I hear a motion to approve Resolution 14?
This is Matt, so moved.
Thank you, Matt. Do I hear a second?
Second, John Harity.
Thank you, John. All in favor?
Aye.
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 Opposed? Abstaining? Okay. Moving on to our next item.
And this is our last seat-based transaction. We'll go back to Elise for this final one.
Great, thanks, Mackie. So this project is at 70 Deerfield Road in Windsor. This project is for Easter Seals, which is probably a familiar name to most. Easter Seals is a nonprofit organization that does really amazing work providing services for things like education and employment support for folks with disabilities, as well as active military and veterans. They're also celebrating their diamond anniversary this year, 75 years. This is actually one of the first solar PV projects that we will be financing with a nonprofit. Mackie mentioned earlier that we have the ability to, now that nonprofits are eligible for the direct pay of the investment tax credit through the Inflation Reduction Act, we're able to also offer the option of a sculpted amortization so they can pay down their loan after they receive that direct pay. So that's something that we've already showed this particular owner. We created two principal and interest schedules to show them kind of the differences between keeping that ITC or paying down in year 2 when they get it. So this is a $765,000 project for a 243 kW rooftop solar PV project. Also a roof replacement with this one, and LED lighting replacement as well. For this next slide, I'm going to pass it over to Larry, who did the underwriting for this. Larry, over to you.
Hello. This is Larry. I'm the newest member of the investments team. So this is a $765,000 project that will start with construction and then go into a 20-year term loan. The loan to value ratio and the lien to value ratio are the same because there is no mortgage outstanding on this property. Easter Seals owns it. There is additional property that Easter Seals of Hartford own, but we only calculated the ratios with this subject property to be conservative. The property is quite large. It's 21,000 square feet and also sits on 7.36 acres. So it's a significant property. Since it is a nonprofit, we evaluated the net operating income a few ways. It does meet our traditional debt service coverage ratio with 1.65. We also looked at it just based on the predictability of their income. They have fairly predictable for a nonprofit income stream because they are service based. So they have some income from their services as well as reoccurring grants and donations. And also they have the rent from this particular facility. They rent out about 1/3 of it to a similar nonprofit. And then we also looked at the group, their balance sheet, which is strong relative to the size of the companies. They have about $4 million in investment assets and $11 million in assets total. Finally, with the DSCR, this is the most conservative calculation in so far as the way the financing will be repaid. As Elise mentioned, this is an early nonprofit with the change in the IRA. So this nonprofit will be receiving a direct payment of the IRA at 30%. So when that money, when that cash comes into the nonprofit, we've given them the option and encouraged them to take it where they would pay that 30% to us. And then that would make the DSCR even better and less risk to us. But that decision hasn't been made by the customer. So this is the most conservative calculation that can be made. That's it.
Thanks, Larry. So again, this is the $765,000 project, hoping to commence this year at 70 Deerfield Road in Windsor with Easter Seals of Greater Hartford Rehabilitation Center. And I think we talked through most of this already, but just to point out, there is no mortgage. Larry just mentioned that as well. And this project will be completed by Greenleaf Energy Solutions. Greenleaf is actually going to be one of the recipients of a Green Bank Award next week for accelerating CPACE in Connecticut. So excited to be working with Greenleaf on this project too. And then again, same situation here. These are calculations that we put together. I think they're actually quite conservative in terms of what we're looking at, but there was also a lighting component in this project, not just solar PV. So there's a few more metrics here that you can see. But again, I think we're pretty conservative, and once our technical team takes a look at this, I believe that SIR will be a little bit higher. And with that, back to you. Chair Reed.
Thank you. Any more questions?
No.
No. No. Okay, do I hear a motion to approve Resolution 15?
So moved, John Harity.
Thank you, John. Do I hear a second?
Bettina, second.
Thank you, Bettina. All in favor?
I,
Aye.
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 Opposed? Any abstentions? Okay. Congratulations to the team. That was a lot of work, a lot of effort, and it's really remarkable to see the CPACE bearing fruit. Thank you for all that.
Yes, thank you all for your support. And yeah, I echo the fact and congratulate the team. It's been a ton of work. It's great to see all these projects.
Okay, so we're moving on to agenda item 5A, incentive program updates and recommendations, progress to targets. Who's taking that? Is that you,
Would be
Mackie?
me.
Okay. Oh, hey, Sergio. How are you?
Good. How are you? Good morning,
Very
everybody.
well.
Right. Let me provide a quick update on the incentive programs, progress to targets number. And I wanted to refer to the second table that shows the breakdown between energy storage solutions and Smarty. On the energy storage solutions, we are a little behind. We have only 176 projects approved out of 380, which is the target. We're at 46.3% of the target. We are missing key market players like Oxygen, Sonova, Tesla, large developers on the residential side that at some point in RCIP, they held 60, 70% of the market share. So without these players, the deployment in this first year of the program has been slow. You can see on the capital deployed perspective, we are at almost 80% of the target. So we are on good track, right? From a capacity perspective, the megawatts, we are at 85.5%. I think we're doing pretty well in those two numbers. We just lost 3 projects totaling 6 megawatts of capacity. The projects just, the customer changed their mind. The projects were not feasible anymore. So we lost probably around 6 megawatts of capacity. We were just right on target, but we lost, just recently 6 megawatts of projects. We're currently reviewing 10 projects that total 13 megawatts of capacity, roughly 17.6 megawatts of capital deployed, and that would put us right on target. It's a total of, we also have in one of these 10 projects, one is a very large multifamily affordable housing project that is a total of 179 residential units, and it also has a charter school. It's a hybrid. It's a combination of residential and commercial. This customer has a fuel cell system. It's a customer in Bridgeport. They have a fuel cell system on site, and they're trying to add backup power capabilities with a couple large batteries. This project check all the boxes. It's residential, it's commercial, it's multifamily affordable housing. They are in disadvantaged communities. They are also on the grid edge. So they are expected to receive a very large upfront incentive. I think we will be ready to bring this to the board in the June meeting. So hopefully by the end of the fiscal year, we will have those, we will be able to add those 179 residential units. So any questions about this section.
This
All
is
right,
Lonnie.
moving.
Sergio, I'm just wondering if
Yes.
there were any, was there any theme to the reasons that potential customers change their minds?
I think the timing of the approval from a interconnection perspective was a key determinant. These projects are expected to take 2-3 years to be approved for interconnection, and the customers said, well, they weren't willing to wait that long, and that they had to drop the projects.
So is there any way to kind of lessen that time? I mean, it feels like a goal going forward.
Yes, it's going to be a challenge moving forward. I know there is a multi-state effort in the Northeast to try to improve this situation, but I don't think there's much we can do. These projects will sit in the interconnection queue for months. There is no doubt.
Wow.
I think we have one commercial project, one CNI project that is about to come online, but it's relatively small. So the interconnection was relatively easy from a utility perspective. But these large systems, we're going to be waiting. Yeah, unfortunately.
Okay, thanks for that explanation. I appreciate it.
Yeah. So moving on to the third table on the vulnerable communities, the deployment in vulnerable communities, we are at 40.13%, just right on target for the energy justice 40 goal of the program, of the battery storage program. The next table shows the breakdown between energy storage solutions and Smart E. Both programs are just at 40%. So both are doing extremely well. If we go to the next table, the last table that shows the breakdown of the energy storage solutions component between CNI and residential, you can see that the key driver has been CNI projects. As I said, they're very large projects. They're easily, or many of them has been located in disadvantaged communities on the grid edge. So they are largely the key contributor to that 40% on an aggregate. Unfortunately, on the residential side, we're still lagging. I think the deployment in underserved communities is just under 10%. And it's a consequence of, as I mentioned before, the key market players not being ready, particularly Posigen. I think they are about to launch their marketing campaign. They're ready to go. So we should see these numbers improving shortly on the residential sector. So any questions? All right. That's all I have. Thank you.
Sergio, just I guess words of encouragement. Maybe keep up the efforts on the residential side of the vulnerable communities. It's great our numbers are at 40, but I think, like you're saying, reading inside the numbers, are we really getting to some of the ratepayers that we want to help? And it's always been a tough nut to crack. So I just encourage you to keep at it.
Yes, we're working on it, Matt. As I mentioned, this large multifamily affordable housing project will help us with that percentage, right? Because each apartment, and it's 179 of them, each apartment will count as a project. So that would shoot those numbers through the roof. And hopefully by June, we will be in a position to approve that project.
I had one question, which is when we have periods, we've had a few periods of like a perception of a volatile economy, whether or not it actually was. That's the way it was being reported. Does that have a big impact on people's willingness to go into these projects and take on the debt?
John, on the residential side, we don't see that happening. The key driver is, from a residential perspective, is backup power, and unless we have an outage, a significant outage, people just, I guess, they're having a hard time seeing the value of storage, right? Until we have an outage, and then we will see, I'm sure we will see the number of applications going up. But for now, I mean, the electric grid has been relatively stable over the last years. And so it's a difficult sell on the resi side.
I would just add, though, I guess on the commercial side, certainly the increase in interest rates is probably having an effect on the large projects. I mean, I think it causes the increase in interest rates has been dramatic over the last 12 months, 9 to 12 months. So a number of those projects that might have been feasible at a 4 or 5% cost of funds, these guys are now penciling them out at 8 to 10% cost of funds. So that can have quite an impact. You also have, I think, Sergio, probably ongoing supply chain issues, things of that sort, related components and stuff that is perhaps slowing some deployment down on the commercial side, not the residential side. The residential is, as Sergio said, it's, the product is new, the value proposition isn't altogether, clear. Some people who really want it because they just like new stuff and they're early adopters, they go for it. But we're still in the early rollout phase. That's all.
Well, thank you both for that. Thanks.
Thank you all.
Okay, we're moving on to agenda item number 6A, investment updates and recommendations.
Thank you, Chair
Is that you,
Reed.
Bert? Oh, good.
Yes, good. Oh, can you hear me?
Yes.
Okay, great. All right, thank you. This is the first product expansion of Smarty in a while on the basic energy efficiency solar side. So this is really kind of exciting for us. This idea actually came from out of discussions that we have been having with a contractor, EcoSmart, and Steve Pelton is actually, one of the owners and is on the line, and I'll call on him in a moment for some remarks. But and also together with a Smarty lender, the largest Smarty lender in the state, Capital for Change. Homeowners are eligible for a 30% investment tax credit for systems that they buy. It's now extended for 10 years under the Inflation Reduction Act, which is a good thing. Typically, contractors have used 0% ITC loans, same as cash loans, for 30% of the project costs for their customers, side by side with Smart E-loans, covering the 70% to fund 100% of a solar project. The contractors love Smart E's flexibility and the low rates that come with that. But the problem with a Smart E loan is that it doesn't reamortize. So if a customer took out a Smart E loan for 100% of the project and they get their ITC check, in 12 or 15 or 18 months and make a payment, they're still stuck with a higher payment for the 100% of the project cost because the payment doesn't reamortize by the Smarty lender. So contractors like EcoSmart have used a third-party capital source, which has now stopped doing these loans as side by side with the Smarty loan, and with that availability of capital now out of the market, there's been a little bit of a scramble to try to find a solution for that. And working together, we came up with this ITC loan that plugs the gap in the market, but for transactions that would allow these two loans to exist side by side, the regular Smarty loan for the 70%, this ITC Smarty loan for the 30%, and then when the customer gets their check in 12, 15, or 18 months, they can pay that down. But to hear kind of a little discussion about this from a contractor's perspective, Steve Pelton, are you on the line there? And I'm not sure if we could, if we're able to turn on his mic. Not sure who's manning.
I think I heard him.
Are we there?
Are you there,
Yes,
Steve? Oh, good.
Yes.
He's there.
Go ahead, Steve.
Oh yeah, no. Thank you very much for setting this whole thing up. We've had a long history with the loan, with the Smarty loan. We were top performer for multiple years by using the Smarty loan, and for the ITC, we'd use a company called Enterbank. So like you were saying, you pulled ITC out of the loan. Someone was cash flow positive immediately on their solar project, and after 10 or 12 years, they had the balance in free solar, and which is kind of what everyone wants to have happen. Since Enterbank went away, we didn't have that option, and then we start quoting out the Smarty loan, the fully loaded loan, and it's more than their current bill, and people are like, well, why would I do that? So we rolled over to the Sunlight company, which, you buy down points and you do a whole bunch of other things, reamortizes. But you push these loans out pretty far, and it's still not that great for the customer. And as far as competition goes, the guys that are going in leasing, and they, people say, I don't want to lease, as they should say they don't want to lease, they immediately default to a 25-year loan, and the total interest paid over that loan period is a heck of a lot of money. So if the buy down, so another thing we did, we worked with Capital for Change to initiate the buy down for the contractors on the loans to bring down interest rates. That worked out well. I'd like to see that kind of finalized too at some given point, because we did a lot of work with the Smarty loan with the buy down with Cal Vinyl when he was president, along with all the Kelly over there and company. But right now, the money can stay in Connecticut if we can actually have a loan, like you were saying, that reamortizes over a 2 or 3 year period of time. Maybe the micro loan expand the amounts of micro loan can be used. But if there's some sort of payments that be made or points to be paid by a contractor, they're paying points now anyway. That could easily be added to the loan, but it would drive more loans. And right now, people are turning down contracts because they're saying, wait, I don't want to pay 9% or 8, 10, 9%. I don't want to, pay this $20,000 in buying down points. Let me go to my bank. And then the deal just stalls at that point. And then eventually, maybe 30, 60, 90 days later, you get a call back. Hey, I got a loan at the, Massachusetts Smarty place or whatever it is, or what's that loan? What's it called? Mass 5, I think, or they get a loan from their bank, or they have cash, and sometimes they go with it, and sometimes the deal dies because of financing. So a lot of companies are in my same position, companies that sell solar, and if there was an option out there to keep the money in Connecticut, to roll it through the Green Banks programs and the Smart E program, I think you'd capture a lot of money from dividend and also from Sunlight Financial, and I think it'd be better for the homeowners. And if that loan could be pushed out to 15 years with a bridge loan for the 2 or 3 years, depending on the person's appetite for solar and the ability to take the ITC, I think you'd capture a heck of a lot more than you could even fathom right now with contractors that sell solar. And solar sales is actually taking more and more market share as people get more educated, as they have been. And I think that if the money stays in Connecticut and it can be recirculated in Connecticut, it can benefit Connecticut and the ratepayers more than just having the Smarty loan, which isn't as used simply due to the lack of the ITC being a portion of it.
Great.
Hopefully I didn't go along with that.
No, that's perfect. Thanks so much. And if Joe, if you could advance the slide, please. And thanks, Steve. Appreciate that perspective. So this is how it works. You see the homeowner there, having to come up with 100% of the project cost. The way this would work is they would get basically two loans: a regular Smarty loan, as I described, for 70% of the project. You see the little blue box there in the middle, a 30% ITC loan for, meaning covering 30% of the cost of the project. And that would be the same as cash, 0% for the period of time it's outstanding. And that cost is being covered in the upper left-hand corner by a contractor who's paying points to bring that down to a 0% cost. In the lower right-hand corner, the green bank is going to loan or place linked deposits with Smarty lenders at about a 3% per annum rate to enable this to be done at a reasonable amount of points for the contractor. And in that way, when the check from the Treasury comes in 12 to 18 months, the customer can pay down that 30% of the project ITC loan, and is left then with a low payment on that Smarty loan for the 70% that carries on for 10 years or maybe up to 15 years if Steve's thoughts about Smarty lenders extending a little bit more could come to fruition. So that's the idea behind the concept here. Capital for Change, their loan committee approved the structure about a week and a half ago, and so we're now to the board to seek approval so that we can roll this out as soon as we can get through documentation, which we should be able to do in the month of May, and get this all rolling. So we're open the floor for questions, but back to you, Chair Reed. Thank you.
Thank you. Any questions? Okay. Do I hear a motion to approve Resolution 16?
So moved. John Harity.
Thank you, John. Do I hear a second?
Second.
Bettina, I'll second.
Thank you, Bettina. All in favor?
Aye.
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 Opposed? Abstaining? Okay.
Bonnie, just
Moving
one,
along. Oh, I'm sorry.
one comment, which is I want to really thank the contractor, Steve, for joining us. It's good to hear from the people actually using the products about how they could be improved. That's like, I think, tremendously helpful.
Yes, very helpful, Steve. And, any kind of future recommendations we'd be happy to have. Because I think this is where, the real world experiences are where it's at. So we really appreciate that.
Thank you.
Yes, and I have to point out that this is, thank you again, Steve. And this is part of, I think Steve came to us, I think it was, if I'm not mistaken, Steve, it was at the end of February. So we really jumped on the trying to develop a concept that would work. We went back and forth very quickly and brought it, about 2 months to the board. So thanks for working with us, and also to Capital for Change for working with us in pretty much record time. And we're looking forward to rolling this out as soon as possible.
This is Bettina. Maybe I missed it. What's the how much money are we talking about as a bridge loan?
Oh, yeah, very, very good question. $2 million for Capital for Change and $3 million for other Smarty lenders. Capital for Change is the largest one in the market, and they have roughly a 50% market share. So that's why we did the allocation that way. And this is a pilot. If we need to adjust those numbers, we will come back to the board for approval. Thank you for that question. That's a good point. Should have been a bullet on the slide.
Yeah,
yeah.
I didn't get my question. Okay, thanks.
Thank you.
Thank you. So moving on to our next item, environmental infrastructure
Yeah.
updates.
No, this would be the 6B, the IPC loan facility modification, and then we
Oh, I
have
see.
then we have 6C, so which Luis Della Pesca will take up. But this is the item on that's up. If you can move to the next slide, please. This is the revolving line of credit that is in place with Inclusive Prosperity Capital. This is provided pursuant to our MOU arrangements that were entered into originally back in 2018 and then modified in June of 2021, just before that MOU extension, where the board extended the arrangements under the MOU from 2024 to 2026. The line of credit was increased to $1 million, secured by the remaining fees payable to IPC under the PSA, the various PSAs that we have with them for things like SMART-E, like we just discussed, for our commercial PPA program, solar marketplace assistance project, and so forth. So IPC has requested that we bring the line of credit in line with the MOU. It was kind of an oversight at the time. We should have kind of moved everything all together, but we didn't. So that they've come to ask us if we would do that. At the same time, Green Bank would also change the borrowing base from LIBOR to the secured overnight funding rate, which is the replacement for LIBOR, which is being discontinued. So that's the nature of the request here. Next slide. It just shows you that without this change, we were bringing down, and this was the first column was the tracking of the remaining fees under the PSA under the old arrangement, and the middle column there is just tracking with the remaining fees under the new arrangement to the maximum level of $1 million, which is the revolving line of credit top limit. So, and you see the remaining PSA fees in the final column there on the right. So if there are any questions, I'll take them at this time, but back to you, Chair Reed, to organize that and a vote on the resolution. Thank you.
This is Bettina.
Okay, go ahead,
yeah,
Bettina.
Bettina. So how much, and maybe it wasn't, yeah. So how much do they still, does IPC owe the Green Bank, or is it like a forgivable loan, or?
No, it's not forgivable. No, it's they're currently, the outstanding is $850,000.
Okay. All right. Thanks.
Sure.
Any other questions? Okay, so do I hear a motion to approve Resolution 17?
Move to approve, Adrian speaking.
Thank you, Adrian. Do we hear a second? A second?
Come on, guys, back me up.
Bettina?
I'd prefer someone else second. I'm sorry.
Okay, Matt? Can't hear Matt. Benu, was Benu with us? Yeah, do we still have a quorum? I hope.
We do. Matt's on. He's just on mute. Vicky can
He is seconding in the chat.
Thank you, Vicky.
Are we seconding in the chat?
Okay. And we still have a quorum. Let me just read off. We've got Adrian, we've got Bettina, Benu, We've got John, Joanna, Lonnie, Matt, and Vicky. We've got a quorum. We've got 8. Thank you, Vicky.
Okay. All in favor?
Aye.
Aye.
Opposed? Abstaining? Okay. Moving on to the next issue.
Okay, thanks very much. And I'm going to turn the mic over to Louise Della Pesca for presentation of the Skyview transaction. Thank you, Louise.
Thank you, Bert. So the background to this request to the board is that we have a senior secured term loan facility with a special purpose vehicle, which we refer to as the Skyview SPV, excuse me. And that SPV is 100% owned by Skyview Ventures. We actually entered into this facility with Skyview SPV in 2020. And since then, we have come back to the board several times to make amendments to this term loan facility. So the SPV that we lend to develops commercial solar power purchase agreement projects in Connecticut. And so far, since we went live with our term loan facility with the SPV, we've actually financed 41 such projects, and we've deployed $6.6 million of capital. So that's the background. Why we would like to amend this facility now is that the SPV has got a contracted pipeline of almost 1.5 megawatts. So that's where actual contracts have been signed, off-takers have been found. It will cost $3.7 million to build those projects. And the Skyview SPV has approached us to provide construction financing. So far, we've just been providing term financing, but the request is to provide construction financing, which we feel well placed to provide. However, the current facility terms and conditions do not meet Connecticut Green Bank's requirements for a construction finance facility, so they would require amendment. Next slide, please. So the controls that we've thought about putting in place in order to put in place this construction financing facility is to use milestone financing, ensuring that when we're financing the construction of a project, we're never getting ahead of the stage of construction. This is exactly what we do with other construction finance facilities that we already have with other borrowers. We would only finance projects that have reached the milestones that are to be defined by us as lender. And then very importantly, we would ring fence assets to ensure that we, the Green Bank, could actually step in to contracts to complete construction and then bring those projects into our portfolio if for any reason the borrower was unable to continue with constructing these projects that we're lending to. The memo that we submitted regarding this request, you will have seen that there was a section of it regarding an underwriting of the parent company to this SPV. The parent company is called Skyview Ventures, and they experienced a downturn in their financial results between the years 2021 and 2022. So the memo goes into some depth about what happened between those 2 years, but why we still ultimately see the parent company as viable in its role as performance guarantor for this debt facility. However, as a further control, as we are amending this facility, if we're going to bring in construction financing terms and conditions, we would also like to increase the frequency with which we obtain financial statements from the parent company, Skyview Ventures, so that we can continue to monitor the financial strength of the parent. The changes that we would need to make after board approval, hopefully, is to add those specific conditions for advancing construction financing that I mentioned above. We also want to charge a higher interest rate on construction financing as compared to term loan financing. And the construction finances will mature in a different way to term financing, because construction financing advances will be repayable at the point at which projects come online and start generating revenue. So I think those are all my slides on the request, and I'll take any questions that you might have before passing back to Chair Reid.
This is Bettina.
This is John Hardy.
Go ahead,
Go
John.
ahead.
No, go ahead, John.
Well, I just had a question. Are these increased controls based on some sort of problematic experience that we had, or is it just like being cautious to insert these things?
So there's the first set of controls that I mentioned are all related to construction financing. We have not used this facility to do construction financing yet, and so we want to insert those specific controls related to construction financing into the documentation before we feel comfortable actually doing construction financing. That last one, which is about reviewing financial statements more frequently for the parent of the SPV, that is in relation to the downturn in results between 2021 and 2022 that we observed. Because we saw that based on a review of annual financial statements, we want to monitor that more closely, and that's why we're going to ask to review quarterly financial statements moving forward.
Thank you.
Bettina?
Yeah, you mentioned that they didn't meet specific Green Bank requirements, but you didn't say what didn't they meet?
Sorry, I may have been I may have been
extra.
unclear there. So it's not that the borrower has to this point failed to meet Green Bank requirements. That isn't the case there. But the term loan facility documentation that we have in place, it needs to be amended in order to allow us to make construction financing advances. So it's a case of amending the documentation that we have in place governing the facility to allow us to use the already approved funds. We already have $10 million approved for this facility, but we just want to make sure that we have the proper controls in place to do construction financing.
And we've used Skyview before.
Yeah, that's right. So we've been working with them as a borrower since 2020. We've deployed $6.6 million. We've financed 41 projects. All of those projects were operational at the time we did the financing. So this is a move towards an earlier part of the development process where they're building the projects.
But you do have a concern about their overall financial shape. I did not read the detailed memo. I apologize, but I'm reading between the lines, and I'm hearing that there's a deep concern to put in these extra controls.
So the controls that are specific to construction financing are unrelated to the financial performance of Skyview Ventures. Those are purely related to doing construction financing. We never want to be at a point where we have advanced more debt than the stage of development of the project, for example. So we're just going to make that extremely clear in the loan documentation. However, the added control of reviewing the financial statements more frequently, I wouldn't say it's a deep concern at all. The parent company remains profitable. It's not a loss-making company. It's just that the level of the profitability has decreased from 2021 to 2022. It's related to a change in how lucrative the REC trading part of the business has been, the renewable energy credit trading part of the business, and how the portfolio of their REC assets has been devalued. And so in recognition of this move downward in profitability, we would like to keep an eye on that. However, that's at the parent level. We are still very comfortable with the underwriting risk of the SPV, which is where we are lending.
And at which stage, when you are reviewing the quarterly financial statements, what will be a red flag that when you're doing that review that you think would warrant bringing back to the board's attention that, this might be a problem?
Well, I think the first red flag would be if it stopped being a company that's making, at the moment it's making, you know, a $2 million net income. But if that is going down and down, if it becomes a company that is loss making, then certainly I think we would want to come back to the board and talk that through. If we were to be at that stage, then I think we would always go back to the fact that we're not lending to that parent company. We are lending to a special purpose vehicle. We have underwritten the projects that are owned by that vehicle, and those projects are what's securing our loan and our comfort with being able to operate those projects if for some reason the special purpose vehicle were to default on the loans that we have made.
Okay.
Well, and in addition to that, if I might say, sorry to butt in here, but one of the reasons we're comfortable with taking on this risk is the fact that the Green Bank started in this position years ago, meaning we actually have experience building projects, you know, putting the panels in the ground or on rooftops, and taking that all those obligations on our shoulders. One of the things that we have made clear, and we'll make sure we're clear with not only the borrower but also in the documentation, that we have full step-in rights without any limitation, so that if there should be a stumble, which we do not anticipate. Skyview has been an excellent partner of ours. They have developed projects with our financing. They have actually bought transactions from us, Louise, I believe. And so, you know, so we've got a great two-way relationship here, and they do a number of transactions for municipalities all over the state, which is a key reason why we're supporting this construction facility. But we wouldn't be doing this unless we had specific experience in doing this type of activity on our own, which we're absolutely happy to step in if the need should arise. So we will make sure that we have those full unfettered step-in rights before we proceed to a contractual close.
Thanks, Bert. I have no more questions.
Thank you. Is there any kind of ballpark idea of how much higher the interest rate will be on the construction financing?
Yeah, we would propose 100 basis points higher than the term loan financing.
Okay, thank you. Thank you.
Lonnie, it's Matt. I just had a question. I mean, I think I've asked it before on this matter. Are we crowding out regular banks who they could go to and get this money? And are we committing money? Is there a reason we need to take on this new role? I guess is a commercial need other than Skyview's desire. Can they not get this financing through a traditional bank?
I think Skyview has had a construction financing facility with a commercial bank. They use that financing facility to cover all the states that they operate in. They operate in all along the East Coast, and it simply isn't big enough for their construction development pipeline at the moment. So one of the reasons that they came to us is because very specifically in Connecticut, which is where they know that our mandate is, they have this development pipeline. They could then be using Connecticut Green Bank construction financing for their Connecticut pipeline and not be kind of taking up the private sector line that they have in Connecticut for Connecticut projects. That we did ask that question. One of the reasons that they like working with us is how well we know their business, how well we know their portfolio, the work that we've done together already in terms of underwriting projects, and the standards that we adhere to when we do so. I think that we're a good partner to them, and that is one of the reasons they've come back to us.
Are the same people that you've been dealing with still running it? Have there been any key changes in personnel?
Not at all, actually. At the level that we operate, the decision-making level, none of those personnel have changed. Some of the more junior staff have moved on, but since 2020, all of the decision makers are still the same people.
Thank you.
Louise and Bert,
Any more
would you
questions?
say that their credit worthiness is not changed by the decrease in profitability? Or is their credit worthiness the same as it was when we started, or is it less? And if so, is it reflected in the rates?
I mean, I would like to answer that question first talking about the borrower, because the borrower is this special purpose vehicle. It has, you know, an even bigger portfolio of assets. It's more credit worthy now, today, than it was when we started the facility because of how much more collateral there is at the borrower level. And we underwrite each project as a specifically that project we underwrite, and that is what we're very comfortable because we know how to develop exact same type of projects. So when they're developing a project with the town of Fairfield, we feel comfortable in underwriting that project. So I wouldn't say the credit worthiness of the borrower, which is the SPV, has been affected by the downturn in results of the parent. And I'll let Bert opine on whether he thinks creditworthiness of the parent has been affected.
I would say that it's certainly always better to make more money than less, but I think what I think I'm appreciating about Skyview and the way they're approaching the market is, given that they are seeing a shift away from higher profitability in the rec market, as Louise mentioned, they are now emphasizing their work in their solar portfolios as well as EV charging networks, which they recently acquired a substantial portion in California. And so, these are projects that will over time increase in terms of their revenue pie as, say, the rec portion decreases. So they're very smart people in this renewable space, and I like the way that they're balancing out their portfolio a bit better with the other two revenue lines. So, as opposed to, say, sticking with one thing and then trying to make it work and then perhaps coming up short, and then they get into trouble. That's how I look at it, Matt.
Thank you.
Any more questions, comments, concerns? Okay. Do I hear a motion to approve Resolution 18?
Binu Chandy, I move.
Thank you, Banu. Do I hear a second?
Second, John Hardy.
Thank you, John. All in favor?
Aye.
Aye.
Opposed?
Lonnie,
Abstaining?
it's Matt. I just have to abstain.
I was waiting. I thought,
Well, it's not the merits. It's I do projects that they're on the
I
other side
figured.
of.
I thought, wait a minute. Okay. All right. Thank you. Thank you.
Thank you.
All right. Moving on to our next item.
All right. So, just a quick update as to where we are with environmental infrastructure. Um, as most of you are aware, and you may have seen our press release from earlier this week, we have hired a director of environmental infrastructure. Lee Welton joins us from the Conservation Finance Network. She'll be joining us full time in September. She'll be doing some consulting work with us prior to her transition. And we look forward to her joining us. I want to extend a thanks to the members of the board and the members of staff who spent a great deal of time in this search, meeting with a variety of candidates, and a special thanks to Joe Buonanata for all of his logistical support and advice and in making this happen. So we look forward to Lee joining us. So I can go through this as well, Madam Chair, if you'd like.
Oh, good.
So, so as many of you all might be aware, we are required statutorily to provide an update to the legislature with regard to the RCIP program. Even though that's ended, we owe the legislature a report. We filed an initial report in January and have been working with our colleagues over at Slipstream to do a full program evaluation to speak to the impacts and efficiency of the RCIP, being that that's now wound down, and the recommendations just in general as the solar market transitions here in Connecticut. I'd like to turn it over to Dan Straight and Lee Shaver, who are our fantastic colleagues at Slipstream.
Right. Well, thank you very much, Eric. It's really we're grateful for the opportunity to present the results of this report and the recommendations. I'm joined, as Eric mentioned, by my colleague Lee Shaver, who worked closely. We worked closely together on this analysis. We both are with Slipstream. We're a nonprofit organization that has a mission of accelerating climate solutions for all. I'd also like to just acknowledge the contributions. Eric has been an invaluable point of contact and resource throughout this project, and then also wonderful help and insights from Lucy Charpentier, Sergio Carrillo, and Paul Howarth. Next slide, please. So the objectives of our evaluation and recommendations were first to assess the impact of RCIP, the Green Bank's residential solar investment program within the Green Bank's evaluation framework. We looked at the overall impact of the program during its 10 plus year life cycle, as well as trends in participation and production in the program over time. We also, in recognizing that residential solar is not equally accessible to all Connecticut residents, we evaluated how equitably the program had been delivered. Now, given the concurrent transformation of the solar market nationally and globally during the same period, seeing that there was an increase in solar adoption in Connecticut wouldn't stand on its own as being an indication of success for the program. So we wanted to compare RCIP's impact to on the Connecticut market to markets in neighboring states as well as the market nationally. So with that, we sought to investigate the program's effectiveness by comparing its production and the overall rate of solar adoption in Connecticut in this to equivalent metrics in other states in the region, as well as to national trends. And then within that analysis, we also wanted to look at overall adoption rates, but also wanted to understand who was participating, who was accessing solar in Connecticut versus who was accessing it elsewhere, and looking primarily from an income standpoint. Lastly, because since the RCIP achieved its statutory objective of 350 megawatts of added capacity, exceeded it, we were asked to provide insights into where the market stands now, a year plus after RCIP has ended, and then also to provide some recommendations for how the Green Bank can continue to support the market moving forward. Next slide, please. So for the our methodology, we started with background research, make sure that we could ground our evaluation fully in the Green Bank's evaluation framework. And then one of the challenges that we anticipated were that each of the states in the Northeast use considerably different incentive structures, credits, tariffs to support residential solar, and we wanted to make sure that we had a solid grounding for how we would go about doing that comparison. We looked at the RCIP program data. There's a lot of it. We looked at, we received a data set or access to a data set of, I believe it was 46,651 completed projects with about 200 plus data points for each project. So there's a lot to look at there. We used that project data to quantify RCIP's both energy and non-energy impacts over time, as well as how what those trends were, how they changed and evolved in comparison to elsewhere. But also, in addition to looking at the added capacity and energy production, we also wanted to look at how effectively the public investment had leveraged private investment, as well as the environmental and economic benefits that the installed solar had generated during that time. We did also need to gather data, external data, looking at one of the significant tasks was to try to collect equivalent data, or at least data that could provide some insights from other states in the Northeast, as well as New York and New Jersey. And then once we had that data, conducting that comparative analysis at the program and the state level, we were also able to incorporate data from Energy Information Administration, Lawrence Berkeley National Labs, and the Solar Energy Industries Association to help support that analysis. And then the last part of our methodology was that we did stakeholder interviews with both of the electric utilities in the state, as well as with Solarize Connecticut, or Smart Power, and then the Connecticut Solar and Storage Association. And then a fair amount of email correspondence and phone calls with folks in other states to understand contexts there. And I'm sorry, I am realizing that there's a, are we able to extend beyond the 11 o'clock timeline? I'm just realizing that we're running up on that.
Is everybody, who has a hard stop? Well, I don't think we have to vote on anything, right?
There are no more
Eric?
There are no more resolutions, Madam Chair. I think this is the penultimate item on the agenda. If we could pause for 1 second, I'd love to just touch on one quick thing, and then we can come back to you, Dan. Is that okay?
Please do.
All right. I just want to take the opportunity while we have most of the board here to thank Mayor Hoydick for her service on the board. She recently informed us of her intention to depart from the board due to some time constraints. So I want to thank Mayor Hoydick on behalf of the organization for everything that she's done. And in the slides, we do have some updates on the community's leap in Bridgeport. So I urge you to take a look at those pictures. But with that, no further ado, I'll hand it back over to Dan.
This is Lonnie, just for a sec before Dan. I just want to say about Mayor Hordick, and he was the minority chair on the energy committee for years and years, and we worked together on so many of these things. And it was so great to have her aboard this board. But she has said, you know, she's now also an officer in the Connecticut Conference of Municipalities, that she's going to stay engaged with us and be helpful to us and reach out to us and really keep the information flowing. So we thank her for her service. We realize that everybody wants her attention and everybody wants her time, and we're grateful for any she can give us. Okay, Dan.
All right, thank you. Next slide, please. So first we'll look at the results for the program's effectiveness within the state. Next slide, please. And I will try to move a little bit more quickly through these slides. But essentially this chart shows the capacity over time that was produced through RCIP, as well as the average incentive rate. So can hypothesize from this that initial program stimulus of high levels of incentives sent a strong signal to developers and others in the Connecticut industry to jump in and start investing, and that enabled really great leverage and participation over time. So next slide, please. This is probably the single chart that best shows the impact of RCIP on accelerating the Connecticut solar market in comparison to national average. The dotted line is the national average. You can see that back in 2010 up through about 2014, Connecticut was tracking right with the rest of the country. And then the RCIP started to see results, and the yellow line pulls ahead of the national average and just keeps putting more and more distance between national average. So really a clear sign of success here. Next slide, please. So as I said, that the in addition to just looking at how successful was RCIP in stimulating the market overall, we wanted to take a look and see how were people at all income levels, all Connecticut residents, how effective was it in enabling access. So this chart shows success in that. Once again, the dotted line is the national average, and that's for the percentage of solar installations that are taking place in census tracts in which the median income is less than the area median income. The solid yellow line shows the equivalent rate in Connecticut. So once again, kind of tracking about with the national average for a good while. And then in 2015, the Green Bank started to offer the low and moderate income performance-based incentive. It's an enhanced incentive for income qualified households. Then also initiated some key community partnerships and industry partnerships that directed the attention of solar developers into low and moderate income communities. The black line is an indicator of levels of participation within communities that are have within one of the 5 designations: vulnerable communities, CRA eligible, EJ40 eligible, or I'm sorry, EJ communities, Justice 40 communities, and I believe there's one more that I'm leaving off there. But the overall share you can see of the program's participation, it's in some years it was well over half of participation. So that's really significant. And it shows a sustained increase there as well. Next slide, please. Oh, and I apologize. There's something with something happened as this was converted into being displayed here. So I'll try to explain this a little bit more. But the program's evaluation framework recognizes that customers who finance their installation with a lease or with a power purchase agreement are realizing energy cost savings or reduced energy costs, but they also have an ongoing expense with that. So what this chart is showing, and I think the display is a bit clearer within the report itself, but is that for income qualified customers as well as for households in low and moderate income communities, they on average were saving reducing electricity use between 70 and 80% through adding solar. And that there were very robust energy cost savings as well, even after the financing costs are accounted for. So with that, I will hand off to Lee, who's going to talk about some of the regional and national comparisons.
Thanks, Dan. Can everybody hear me?
Mm-hmm.
All right,
Yes.
thanks. Next slide, please. Excuse me. So this slide, another really big takeaway here, just showing how the rate of residential installations in Connecticut compares to area states or neighboring states. So you can see, and then the yellow line with the round markers is Connecticut, and the dotted line there is the national average, and then there's a rainbow of colors for all of the other states that we did comparisons to. But you can see that starting around 2017, Connecticut pulls ahead of all other states in the region, and is the first state amongst those in the region, and continuing to be ahead of the national average in terms of annual solar installations. Next slide. So here we looked at comparing the watts per capita, so how much solar installation is being installed versus the dollar amount that's being spent on incentives. So that solid blue line is the watts per capita shown for each state, and then the dotted purple line is the dollar incentive. So over time, you want to see the rate of installations, that blue line increasing, and the purple line decreasing. You should be getting more solar installations for less incentive dollars. And that is, of course, what we see in Connecticut in the first chart there. And not only is the rate of installation highest in Connecticut, as we've established, but that the dollar incentive per installation is also among the lowest, and then the spread between those two is the greatest. So that represents significant success there. Next slide. And then another aspect that we look to is how cost effective was RCIP in reducing carbon emissions. So the two data points on this chart here, the light blue bars are the dollar amount of incentive that was spent for every ton of carbon emissions reductions that was achieved. So in this area, Connecticut is kind of near the average, a little bit lower compared to other states in the region. But what's significant here is that the rate of reduction is low for the region, but the cost is also very low. So that dollar per ton reduced is amongst the highest for the region when you consider that the total emissions reduced is below the regional average. And then I think we're back over to Dan.
All right, thanks, Lee. So as I said at the beginning, one of the objectives for the evaluation was to provide recommendations to the Green Bank on how to, what its role could be in supporting the ongoing orderly and sustainable development of the residential solar market in the state, given the transition from RCIP to tariffed solar, the RRES program. Next slide, please. So the first category of recommendations is just related to keeping an eye on the market, monitoring it. There's no longer, Green Bank no longer has direct access to those 200 data points on each completed installation. However, the electric utilities are required to file reports with PURA on levels of participation. There's also really good insights from the Solar Energy Industries Authority or Agency, Association. And so we definitely encourage the Green Bank to continue to track that, to keep an eye on the market. However, both of those sources will provide lagging indicators, lagging data for what's really happening. One of the additional sources of information was that as we talked with stakeholders, and this was utilities, the community focused organizations and trade associations, everyone consistently, without prompting, identified the Green Bank as a trusted convener that brought together parties with diverse interests to the table to create solutions that enabled that uh, ongoing sustainable development of the market. So the Green Bank within the industry is definitely seen as a trusted convener. And so we would encourage the Green Bank to remain involved, remain connected to these stakeholders, because they will also likely be the ones with the best and fastest, most real-time insights available to what's happening. And then the last one within this category is that, as I mentioned earlier, there's a really robust data set showing trends in participation over a decade. And as the Green Bank continues to implement strategies to support additional emerging technologies, it can reference this data set to anticipate what market responses might be to external influences, and also to identify who's participating, who's adopting new technologies, who already participated in RCIP, and what might be learned for structuring future programs around that. Next slide, please. So both of the electric utilities do offer adders, adder rates for low and moderate income households who access the tariffed solar, the RES program. However, what we heard from stakeholders was that solar is sold and not bought. That solar happens where there are developers who are selling PV to homeowners, to households. And so the low income adder on its own is unlikely to provide the sufficient support to sustain ongoing participation by low income households. And that's what we're hearing as far as initial feedback on the rate of participation, is that participation in low income communities is falling once we post RCIP. So with that, we encourage the Green Bank to continue to expand partnerships in the low and moderate income communities to really promote that, continue to support solarized campaigns, and then also track the LMI participation data in our res, and then also explore new equity-driven financing tools. So there is new funding coming through clearly from the Inflation Reduction Act and from other federal sources. See where there might be opportunities to use that to create a new financing vehicle directed at supporting participation by low-income households. And in combination, another strategy using the Green Bank Capital Solutions Fund to provide financing for innovative business models. Posigen really seemed like a success story, and offered a really innovative solution that the Green Bank provided important capital for implementing. And that was key in the success of RCIP in supporting low and moderate income participation. Next slide, please. And then our last recommendation is to really engage fully in the solar plus markets. So by solar plus, we mean solar plus battery storage and solar plus home EV charging. And there are a lot of the same companies and organizations that with whom the Green Bank has interacted in supporting the residential solar industry are also entering into those industries. And so continuing to sustain those connections could be a key strategy in continuing to support residential solar as well. And I think the last slide just has our contact information. So I know that we're past the 11 o'clock cut, but we're certainly happy to take any questions that the board may have.
Thanks, Dan.
I,
Are there any
Thank you so
questions?
much.
Yeah.
This is Lonnie. I just want to say, and from a state that competed so much with Massachusetts for so long, that was a nice graph to see. That we've zoomed by them in that department. That's great.
Yeah, Lonnie, this is Matt. I had a comment and a question. It is great news, and the charts are impressive, but it does look like, and maybe this is what you were talking about with the end of RCEP, that our AMI trend line is now trending back toward the U.S. and average in that first chart. So I think we want to be vigilant to keep it going up and not back. And then two, I was curious about the cost of, is this the last slide before the recommendations? Why, if our install rate is high and our incentive cost is low, how do we get to this incentive per ton reduced? Why is our result there not better?
Yeah, I can take that one, Dan. There's a whole lot of factors that went into the calculation here, one of which is the grid makeup comparison between different states. So you can see those light blue bars are very similar for Connecticut, New Hampshire, and New York, which is because the grid makeup there is very similar in terms of power sources. So kind of the second headline here might be the grid is already pretty clean in Connecticut and some of these other states, which means that you have to install more solar. You've got to put more in to make a dent in the remaining emissions.
All right, thanks. Got it.
Any more questions? Okay, thank you.
Thank you very much.
Thank you, Dan. Thank you, Lee. So I believe this brings us to other business, which I've already gone through. And our thanks to Mayor Hoydick. And if Adrian is still on, I don't know, do you want to give a quick update on the Communities Leap in Bridgeport?
Yes, thank you. I'll go quickly because we are a bit over time. And so without further ado, we have spent the last 9 months in pulling together a scope of work that we think is fabulous with our National Renewable Energy Laboratory out of the US DOE, their technical assistance. And we were privileged to welcome a team of 5 people from the US DOE and NREL, and as well as Elevate, that specializes in community outreach. And so in the first quadrant, you see a long table with a blue tablecloth. That was just on Monday evening when we welcomed 50 community members, as well as the team coming in from Chicago and Las Vegas and Oregon, to talk about what our coalition is going to be doing over the next 9 months to a year to plan for our energy future in Bridgeport. You also see the PJ Murphy thing there with two little houses that are waiting to be renovated. That's our community called Little Liberia. And in that photo, you kind of see the whole story about disinvestment from minority communities when industrial activities moved in, which was, between 1870 and the 1950s and 60s when Bridgeport was under its big industrial expansion. So those little houses are from 1848, and they're from two sisters who own quite a bit of property in and around Little Liberia. And that was a community of African Americans, mostly free, as well, or escaped, as well as Native Americans. So we have been privileged to work together with the Green Bank. Ashley and Brian have been stalwart, enormous supporters of our efforts. And we also had Brenda Watson with us. So Connecticut Green Bank is deep in our hearts. You have helped us tremendously through this process of defining what we want to do and how we want to do it, and with the whole notion of community outreach. So the environmental work that the Green Bank is doing, you're seeing the beginning of the results of that in Bridgeport. And I thank you, and the whole Bridgeport community does thank your support and participation and guidance, because this is a very big lift. We have a coalition of about 40 people and organizations working in Bridgeport Regional Energy Partnership, which we shorten to BREP, kind of disobligingly, but that's our short term for it. And we're moving forward with our planning now, and I look forward to continue our work with you in terms of looking toward this environmental seismic time that we're living through. So thank you for the few minutes, Lonnie, and the rest of the board. I'll be happy to give a bigger and more in-depth update in the future, but I think our time has run out.
Thank you, Adrian. It's so exciting because there's such a huge story there and a history there, and to have it go forward in such an incredible way is really remarkable and a great model to be establishing.
Well,
Any
it's been all
questions?
hands on deck, and your hands have definitely been on deck.
Does anybody have any quick questions for Adrian? Okay. Well, we're coming down to visit again.
Good.
Okay, thank you, everybody. So unless anybody's just desperate to stay engaged in this meeting, I'm going to adjourn it. We all okay? Okay.
Definitely.
Have a great weekend.
Everybody.
Have a great weekend. It's Earth Day weekend, everybody. So have a great weekend.
Right.
Have a great Earth Day.
Okay.
Bye-bye.
Bye, everybody. Thank you.